household incomes have grown much riskier over the last 4 decades. And because that has happened during a period of declining overall macroeconomic volatility, not only are households bearing more risk, they're bearing a larger share of total risk that's prevalent in the economy.
If we start to think about many of the issues that we see in the US economy or in the labor market in a context of a dramatic increase in the labor supply globally, we might see that the decisions that were made by some companies to offshore, or the decisions made to actually become more efficient in a supply chain basis, were really quote unquote rational from a corporate standpoint, given that the mandate of each company is to ensure that they are making, again, cost savings and ensuring profitability as far as possible for their shareholders. I mean, again, we have to think about the mandate of each entity and what they're reacting to. So I often think that massive increase in the supply of the global labor force is underestimated for the ripple effects it's had.
I'll just focus on one, expected return, right? We've seen this tremendous trend of lowering of expected return and reducing volatility in most institutional portfolios to try to create some level of predictability, whether it be matching duration to your liability, matching cash flows to your required payments to participants, thinking about funding levels from a PBGC or an actuarial point of view to remain healthy enough so that you don't have to contribute more assets. But if you think about all of those conversations around institutional risk, what happens and what gets lost is, okay, how does this impact the person that is looking forward to a check for now and in for the rest of their lives or their family lives?
We might now be at the point where we have to think whether the shift towards more fiscal policy away from monetary policy actually means something for what that equilibrium interest rate looks like, what our underlying assumption about inflation looks like. These are things that I think a lot of people have not had to think about for a very long period of time, because they have been trending, really trending one way.
We can focus more on real assets, more on commodities, more on diversified opportunities that I think are a lot more tangible, that also have a greater connectivity to the broader economy. So we're going from what I would say paper investors and thinking about risk from a pure analytical or mathematical or formulaic point of view to how do we now connect our decisions and our risk mitigation to the broader economy and participants.
We just had, a near scrape in terms of an institutional crisis in the U.S. itself, and many foreign countries have now said that we'll never see America in the same way again. The point is that institutional weakness translates directly into the sovereign risk premium, into the borrowing rates that a government can issue debt at, and therefore comes directly into the equation about all these interest rate discount assumptions that investors are using in their frameworks. And so, are we trading mild versus wild? I think you bet we are.
Focus on more unexpected events taking place. We are seeing some extremes in terms of inequality and what we're seeing in society, and I think that those tend to be times when we see outcomes that we don't tend to expect.
At the end of the day, my role and my function, I think, in this process is to provide for stability, to invest for stability on behalf of the participants, which I think has a compounding effect to provide stability in the community.